Hello everyone, this is Professor Kent, and some of you are asking me to record some inventory questions at the back of the chapter. This video will be recording those questions at the back of the chapter. I'm going to go through some of the questions, and don't forget to become a member of my channel. It will show you when the new member videos are available to all my members. I'm recording some of the video for my subscribers and some of the video for my members only. So don't forget to check some of the videos under both subscriber channel and under the member channel. Thank you so much, and let's look at the first question. Tansley Limited took a physical inventory count on December 31st and determined that the inventory were on hand. So the inventory they have on hand was 4,000. So we want to know if this is a correct inventory to put it on our financial statement or not. The amount was included the 1,000 goods held on consignment for this company. This is not our inventory. We're holding this inventory belongs to the woods. If it belongs to the wood, we needed to take it out. And how we're going to take it out? By minusing it, because that's not our inventory. Not included in the physical count is 8,000 of the goods purchased from Timmins FOB shipping. Soon as they ship it is our inventory, and I needed to 800. I needed to add it as our inventory. And 400 of goods sold to Meyer FOB destination. It will be our inventory till it reached their destination. So I also have to add the 4,000. The 4,000. We sold it for 600, but the actual inventory is for 400. So if I add it and subtract it, I'm going to get a number, which number is 4,200. This should be reported on my balance sheet inventory, or it will be my ending inventory on my income statement. So FOB shipping, as soon as it's shipped, it becomes customer's inventory. If it's a FOB destination, it is our inventory till it reaches that destination. Our next question is, I don't know what the question is asking us to do, but we will see. They're saying the Ogle Equipment Corporation's journal ledger account of each class of inventory, debiting the individual counts for the increase during the period and crediting for the decrease. The transactions that follow are for raw material inventory account, and debit the material purchase and credit the material when it was requisitioned. So this is connected to sort of a cost accounting. So let's see what the question is asking you to do and see what journal entry we had to do. My first one is an invoice for 8,100. Terms is FO destination was received and entered on January 2nd, 2024. The receiving report shows that the material was received on December 28. What entry would we do? For number one, we will be doing it. We purchase a raw material. Debit will be my raw material. And so that's will be my debit. They did not tell us we're paying on terms. Terms are FOB. They did not say it. If we paid cash, if they didn't say it, we will credit the accounts payable. For the amount here will be 8,100. So this will be my 8,100. My second one will be material costing 7,300 were returned to the suppliers on December 29th. On FOB shipping point terms, they were entered into Ogle's journal ledger on the 28th, even though the return item did not arrive to the vendor's office until the January 6th. Now what happens is that there's no adjustment is needed here because we returned, we did the adjustment. It's a FOB shipping point, so as soon as it's shipped, as soon as we ship it, it's their inventory. So the journal entry was journal entry, there's no adjustment is needed at this point. Let's go to number 3. My third one is the material costing 28,000 FOB destination were not entered by December 31st because they were in the railroad car. This is our inventory, so then it will be raw material. The company siding on that date and had not been unloaded, so it's still here, we have it, so it should be our inventory. Debit will be raw material and credit will be my accounts payable, and that is my 28,000. Going to number 4, an invoice of 7,500 FOB shipping was received and entered on December 31st. The report said the material was received on January 4th. So material was received on the 4th. We should not have been recorded in our inventory. So debit will be accounts payable and credit will be my raw material for 7,500. We shouldn't have entered it. If shouldn't be entered, we have to reverse the entry that they did. Number 5, let's go to number 5. My 5 is material costing 19,000 was received on December. No entry was made on that date. If there was no entry was made, we need to make an entry because we received it on December 31st. So my debit will be my raw material, credit will be my accounts payable. The amount here will be 19,800. I think I forgot to press the record button previously. Sometimes my screen freezes, and then this for number 6. We don't need to do in this case if we received goods because our supplier's warehouse was full and the supplier asked us to hold this inventory behalf, so it is a sales agreement. We're holding the inventory for them and the risk and rewards are not passed on to us, so we shouldn't be recording any transaction on the 6th. Number 7 is material costing 5,500 was received on December 2023 on consignment. If these goods are on consignment from Perry, so these goods are not our inventory. They shouldn't be their consignment inventory. They shouldn't be recorded in our books. Algo, so the Algo is our company. We shouldn't be recording this inventory in our books, so there's no transaction needed because this is not our inventory. It is Perry's inventory. Now the next one is we are going to be doing journal entry or recording a proper balance. We want to know what should we do with each of the transactions. Should we include it in our inventory balance or we should not record it in our inventory balance? In order for us to do that, we needed to go through each one and then we needed to record the inventory. So the next question is 18.2, and the 18.2 is asking to determine the proper inventory balance. So what balance did we start it off with? If they told you what the unadjusted balance we started off with, we adjust that balance. So in the first one, they told us what the balance we started off with. Jacko used a periodic method to record the inventory. A physical counter reveals in our inventory on hand on December 31st. So we have December 31st 2020, and that is my inventory. The balance in my inventory is 234,890. So that's the balance in our inventory account. We need to adjust that inventory account, and we needed to know what should that be. We should add it or we subtract it. Number 2, not included in the physical count is 10,420 is the merchandise purchased on December 15 from Shamshi. So we purchased it. FOB shipping, soon as it's shipped, it is our inventory. If it's a transaction number two, and then it is should be part of our inventory. 10,420. If it's not our inventory, we wanted to know where they should do. They said we're also going to do B, prepare the journal entry using IFRS, and then we'll do part C, what will be the entry for the if they were using ASPE. So we're going to do both together if when we're doing I, B, and C together. So under number 3, sorry. Number 3, included in the inventory is merchandise sold. So we sold the inventory on Sage to Sage on December 30 FOB destination. The merchandise was shipped after it was counted. The invoice was prepared and recorded as sales on account for 12,800 on December 31st. The merchandise costing 7,350, and Sage received it on January 30th, January 3rd. So we don't need to do anything. We already sold it. We have to do an adjusting entry. The inventory, we took it out of our inventory, but the risk and the rewards were not passed on till the January 3rd. So if it wasn't passed on till January 3rd, the transaction, there's no adjusting entry to the inventory on the 3rd. However, for the 3rd, if the company is following an IFRS, and if the company is following an ASPE, we need to do an entry. It should not be sale till the transfer is the risk and rewards are transferred. So I will have to debit the sales revenue account, and if it's on credit, I will have to credit the accounts receivable, and I have to do the same entry. The entry will be for the 12,800. So that's the inventory of 12,800. It will be same entry that we needed to do under the ASPE and under the IFRS. Going further, so what do we do with number 3? Number 3 is I just did. It was included in the inventory because the FOB destination, it is our inventory till it reaches their warehouse. Included in the count of an inventory, included in the count of inventory was merchandise received from Duton on December 31st with an invoice price of 15,630. The merchant service FOB destined. The invoice was not arrived yet, hasn't been done. So, but it was included in our inventory. Number 4, I will not do any adjustment to our inventory. However, we needed to do an adjusting entry. My adjusting entry, depending on what the company is using, they are using somewhere I read it, they're using a periodic inventory system. So what we had to do is, under IFRS, they would have to debit the purchases, and credit will be my accounts payable. Debit will be your purchases, and credit will be your accounts payable. The amount is 13,000. No, the amount was 15,630. The amount was 15,630. So the amount here will be exactly the same, 15,630. So that will be under. So we're going to be doing B and C together. So let's go number 5. Number 5 is saying that not included. We want to know what should we do in our inventory for 8,540 of the merchandise purchase. We purchased an inventory. Merchandise was received on 31st after the inventory was counted. So they counted the inventory. So now we needed to adjust our inventory because they should be part of my inventory. So I needed to adjust my inventory balance of 8540, and the balance that is my transaction number 5. Number 6, my transaction number is included in the inventory was 10,400 inventory held by Yaiko on consignment from Yakel. If we're holding for consignment, that's not our inventory. We needed to take it out from our inventory. So we needed to take it out from the account. So that will be your transaction number 6. Let's go to transaction number 7 and what we're doing. Number 7, do we need to do an adjustment? Do we what do we do? Included in the inventory is included. We want to know if do we need to just do the adjustment for that or not. Inventory was purchased and sold to Campo Shipping. Soon as it's shipped, it should be Campo's inventory. It should not be part of our inventory. It should be taken it out from our inventory because it's FOB shipping. Soon as you ship it, it becomes Camp's inventory. Let's go number 8. Number 8 is excluded. So it is excluded. So we want to know what do we do with that. From the inventory was a carton label. Please accept for credit. The carton contained merchandise costing $1,500, which has been sold to a customer for $2,600. No entry was made to the books to record. We have to do an entry. Now it is we needed to add it into our inventory because it came back. It is transaction number 8. It's excluded. It should not be excluded. It should be included in there. But we needed to do an adjusting entry. When you're doing an adjusting entry under number 8, we needed to do an adjusting entry, and the adjusting entry will be for the amount of $2,600. Let's do the entry for transaction number 8. So transaction number 8, if this company is falling in IFRS, they will call it a refund liability. And if it then credit will be my accounts receivable, the amount will be $2,600. If the company is following an ASPE standard, it will be just like a normal sales returns and allowance. Credit will be my accounts receivable and the amount will be for the $2,600. Let's go further and see what else is there. So number 9 is that number 9, Yaiko sold 12,000 of the inventory to Simply Corporation. So we sold the inventory on account. These are items was FOB shipping point. As soon as you ship it, it is Simply Corporation's books. The term of the sales indicates Simply will be permitted to return the unlimited amount until May 15. Yaiko has never provided unlimited returns in the past and is not able to estimate the amount of the physical return. If we cannot, so what we have to do is we sold that inventory and this is going to be returned, so this shouldn't be we shouldn't take it out of our inventory. It should be still a part of our inventory. It's not till May 15th, so I needed to add it back the 12,500. But the amount that we needed to do an adjustment for, because it's not till May 15, 2024, on December 31st, we needed to do an adjusting entry. My adjusting entry will be debit will be a sales revenue because we should never recorded the sale. So that will be my 21,000, and then my 21,000, my debit will be under the ASPE will be same entry. Debit will be sales revenue and credit will be my accounts receivable for 21,000. So this will be my transaction. Let's see I showed you both under the ASPE and IFRS, and we showed you how to do the entries if they shouldn't be part of it. Now number 1813, it's saying is assuming that the ASPE is follows, show which of these items typically be reported as a part of the inventory. So we want to know if they should be reported, if they shouldn't be reported, where they should go under both under ASPE and IFRS. Let's do ASPE, and then we can also kill two birds in one stone. So what happens is everything is similar with the IFRS as same as ASPE most of the times in the inventory, unless something happens. So let's look at it each one, and we're going to see what do we do. Should we add it to the inventory or not? Number one, goods out on consignment to another company. They should be, I'm just going to put it reported as an inventory. Reported as an inventory. Goods sold on installment basis. If we sold goods on installment, and that is should be it should not be reported as my inventory, but it will be it is cost. It is cost of goods sold. If it's a cost of goods sold, it will sit on my income statement. Number three, it says goods purchased on FOB shipping point and they are in transit. Goods we purchase it, that's our inventory, so they will be reported as my inventory. I am going to go to number four. It says good purchase FOB destination, that are we purchase it, that is not our inventory. If it's not our inventory till it reaches our warehouse, so not reported as an inventory. Number five is goods sold to, we sold them to another company, with the seller signing an agreement to purchase the goods at a set price, cover all the costs related to the inventory. They're just we sold it to another company, but they should be part of our inventory, because we have an seller signing an agreement to purchase at a set price, but it should be part of our inventory, so should be reported in our inventory. Number six is goods where large returns are predictable. Large returns are predictable, and that should go to my cost of goods sold. That's as an expense, cost of goods sold, and that should sit on my income statement. Number seven, FOB shipping point, and they are in transit and they are sold soon as we sold it, and they should not be part of my ending inventory, and they are cost of goods sold section. We're going to number eight. My number eight is FOB charges on goods purchased. It should be part of my inventory if the company is using it perpetual inventory system, so it should be part of my inventory. Number nine, freight charges on goods sold. So one is a purchases is your inventory, sold will be your selling expense, or we call it a freight out. Selling expense, or we call it a freight out. Going to number 10, my 10 is freight factory labor costs incurred on goods that are still unsold, so they will be part of my inventory. So number 10 should be part of my inventory. 11 is interest costs incurred, so this is the interest cost, and it's incurred for inventory that are routinely manufactured in the company, so that this is an interest cost. this should be capitalized. So it's an interest cost. They shouldn't be part of my inventory. They should be capitalized. Number 12. Number 12 is costs incurred to advertise. So that will be my advertising expense. If it's an advertising expense, it goes into my income statement. Number 13 is material on hand, not yet replaced into production. That will be my inventory. So it'll be a material inventory. Number 14, supplies used is my adjusting entry. If it's my adjusting entry, I needed to adjust my supplies account, and also I will have to debit my supplies expense, and it has nothing to do with my inventory. My number 15, it says raw materials. My inventory, manufacturing has started into the production, which is not completed completely processed, so they will be part of the inventory. In this case, it will be part of my raw material inventory. Going further, number 16, it says manufacturing supplies. Supplies are my inventory, so they will be part of the supplies inventory. Number 17, goods held on consignment from another, not owned by us. If it's not owned by us, it's not part of my inventory, so we will not record this inventory. Now number 18, so 18 is my goods held on consignment by another company. That's our inventory. They should be our inventory. So it's our inventory, but it's held by another company. They're selling our goods. On the 19, my 19 is costs identified with units completed by manufacturing, not yet built. So it will be part of our inventory. Goods sold on FOB destination. FOB destination is our inventory reaches customer's warehouse, so that will be part of our inventory, reported as an inventory. 21 is a temporary investment on a share, so that will be my current asset. That has nothing to do with my inventory, so that goes under my debit, my temporary investment. It could be fair value net income investment. 22 is saying that cost unclear land, clear land to be developed by a property development company. So they are holding this land to develop it. That is part of their inventory, so it should be reported as an inventory. Number 23, cost of normal wastage or spoilage raw material into the production, and that is so the spoilage raw material during the production, so that will be part of my inventory. If it's an abnormal, that cannot be included in our inventory. Normal spoilage is, abnormal is not, so it's not part of my inventory. Going further, number 25, let's see what they're asking us to do. Storage, a cost of a storage of a material, that will be my expense, cannot be an inventory. 26, cost of store wine as it ages, so that, because that cost is part of my inventory, because it should be reported as an inventory. Now, decomposing cost incurred as a part of the extraction of mineral. You will learn this in chapter number 13. Chapter number 13. When you go there, this is when you do that, you will be learning that. So this is not part of the inventory. You will learn it. It's a new topic. It's an asset retirement obligation, we call it, but you will see it. So now same transaction will be done. The only thing is the criteria under ASPE and IFRS different. So that's the only thing is different, is the criteria. How you record that is different. That's all there is. One is a if it's for a long term, you capitalize. If it's a short term, you needed to record it as an expense. Let's look at the last one, and we wanted to know what should we do with this inventory. Should we include it or should we not include it? So what should we do under the private, and what should we do under the private company and an ASPE company? So let's look at it and see what we could do. We started off with a balance of 441,000. So number A is, based on the information provided above, calculate the inventory that should appear on December 31st, 23 statement of financial position. So what we did is we started off with 441,000. So the inventory that the physical inventory count they told us is 441. Either we add or we subtract to this inventory when we go through each of the transactions. The merchandise 61,000 is held by, so we are solar company on consignment from this. So this is not our inventory. This is consigned goods. So they are goods on consign. So I'll just put it goods, consignment goods. So number 2 is saying merchandise costing 33,000 was shipped by solar FOB destination to XYZ. This merchandise was accepted by XYZ on January 6th. This should be part of our inventory. So it's FOB destination. Destination is until January 6th. Number 3, merchandise costing 46,000 was FOB shipping point. If it's FOB shipping point, it is in transit to the customer shipped. It should be excluded from our inventory because the title has been passed. So it should be excluded. But if they did it already, we don't need to do any adjustment to that. Number 4, 73,000 of the shipped FOB destination. So FOB destination from wholesaler. So we want to know when should be included. It is in our they shipped it. It is a FOB destination. It is their inventory till it reaches us, and it's not going to reach us till January 3rd. So there is no adjustment to be needed. Number 5, merchandise costing 51,000 was shipped by distributor limit FOB shipping point. Soon as they ship it, it is our inventory. We're going to be adding 51,000 to our inventory. Number 6 is solar had excess inventory and incurred additional storage costs. So this is an expense. So this is an expense and that cannot be recorded as my inventory. So that's the other thing they're saying. If you don't put it in the inventory, what you do, that cannot be recorded as an inventory. Number 7 is your solar incurred 2,000 of an interest expense on the inventory that was purchased through the delayed payment plans. So the interest costs incurred on the delayed purchases inventory that are ready to sell or use are not a product cost. So they are not a product cost. So they're not, should not be recorded as an inventory. Should not be recorded as an inventory. So the difference between the IFRS and ASPE is that this interest cost is going to make a difference. One should be capitalized, the other one should not be capitalized. So depending on the company, if interest costs, if it is capitalized, they should be a part of the inventory. If depending on the interest cost, if it's an ASPE company, if it's a capitalized, they should be part of my inventory. If it's not capitalized, it should be expense under the ASPE. Under the IFRS, um, this cost is capitalized, so it is capitalized as a if the inventory is inventory takes a long time to produce and manufacture. So if the inventory takes a long time to manufacture or produce, it should be capitalized, and they should be part of the inventory. Now what happens in this case, when you think of an inventory, when we think of an auditing, we think of a cutoff. That's what we look at when we think of a cutoff, that of an inventory of a transaction. So what happens is that when we, from each transaction, we wanted to know how much is when is the cutoff. So we have to test the inventory for cutoff. The auditor could perform the following tests in order to do that. For the first one is the merchandise that's sold that is held by consignment by bond corporation. So what you're going to do is you're going to look at each of the transaction and see should they be included or not. But they're not looking for that. They're looking for what cutoff inventory transactions are in the event of this. So let's look at the first one. The first one is you could look at here, if the cutoff date, you're looking for your shipping document. So you're looking at your shop document details for the time, at the time they counted the inventory. So you're looking at the shipping document, and at the time of I'm just going to put it at the time of the inventory count they did, the company did. Number, if you were to look at it, if the goods were shipped or received within the 5 days before or after the year end, they should be part of the inventory. If not, then they shouldn't be. So that's what it means. So the auditor will look at it. The auditor will look at the shipping document at the time of the count of an inventory. They will say it is within the 5 days or not. Then number two, this is when we are FOB shipping point, they're accepted by January 6th. Now this is a management's procedure for taking control of the inventory count and related to cutoff. So we needed to follow up with the management, saying that how they did the count when they did the inventory. When you think of number three, I know I'm just talking about it, it's too much to write, but you could just kind of flow through it. This is FOB shipping point. We shipped it to December 29th, and they received it on the 10th. So we wanted to, in this case, we as an auditor, we wanted to verify the goods that were it's a FOB destination. We wanted to make sure that FOB shipping, we wanted to make sure they are excluded from our inventory. Number four is a similar, it is FOB destination. We needed to verify that they should be included, the inventory are included our inventory, because it's a FOB shipment. We have to verify it if they are included when we did the physical count of our inventory. When we're doing number five, they're saying merchandise costing was shipped to the distributor limited FOB shipping point and received at Solero office on January 2nd. What we could do is we can scan the purchases, we can scan our sales journal for any unusual items that impacts the cutoff. That's what it means. And the other ones are not part of my inventory. If they're not part of my inventory, they are part of my expense, or we capitalize it depending on if they're following an IFRS. Under the IFRS, they will capitalize it. If it's takes a long time to manufacture the products. This was some of the questions related to the inventory of chapter 8 volume 1. Some of you guys asked for me to record it. I'm recording it as per your request, and this video will be posted in the normal subscriber under the subscriber channel, not under the member channel. But don't you can get some of the videos that are not posted for the for all. It is not posted for all subscriber. It is posted for only member videos. Thank you so much for watching my videos. Thank you for your comments. Thank you for liking the videos. Take care and bye for now.